Holy crap, markets are looking super rough right now, but it could be about to get a lot worse. Our portfolios are taking a bit of a hit, but now there's a potential credit crisis on the horizon. Things are starting to break. And if that credit crisis hits, things will get way worse. But here's the crazy part. Well, this spells trouble for a lot of things. It might actually be, in a weird way, a win for Bitcoin. I know it's good for everything's good for Bitcoin. Let's dive down into what's going on, why it's so scary, and why, in a weird way, Bitcoin could actually come out on top of this. So first, let's talk about credit spreads. Super boring, but what are they? What can they be considered a useful indicator of sentiment for? And a credit spread, of course, is the difference between the yield or interest rate on a corporate bond and a U.S. Treasury bond. Now, corporate bonds are loans to companies, while Treasury bonds are loans to the U.S. government. Okay, pretty easy idea. Now, in theory, those U.S. government bonds are super safe because the government always pays back, right? Right. In times of economic stability and in low default risk, the spread tends to be a lot tighter as investors are more confident in corporate credit worthiness. Conversely, during times of crisis, economic downturn, or really just any kind of financial stress or uncertainty, the spread widens quite significantly due to heightened concerns about corporate defaults, aka people worried companies are literally going to go bankrupt and can't pay their bonds back. That reduces a lot of market liquidity. You see, loans to private companies are considered much riskier. Who's more likely to go bankrupt, some random company or the US government? The answer's obvious. Sometimes these companies just can't pay the loans back, so investors essentially will demand higher yields from companies on average to lend to them. For example, if a Treasury bond yields 3.5%, a corporate bond might yield 7%, making the credit spread 3.5%. Now, right now, credit spreads are starting to spike, which is a worrying signal. They're getting much wider, and it's happening very fast. Investors are worried that companies might not pay back their debts, especially as the economy slows down. When investors start getting nervous like this, what do? They pull their money out of corporate bonds and run to safer options like U.S. Treasury bonds. Now that fear, that uncertainty, that nervousness is a big red flag, and it's pointing to the potential, underline that word potential here, okay? The potential for a credit crisis. Now, we've all been waiting for our crypto coins to move one more time, but unfortunately, the wrong rocket was fueled. It was the downward rocket into Armageddon here. Charts are showing a sharp rise that looks almost vertical here for credit spreads, and that's not a good thing. At the moment, the fear is accelerating due to fears of course, recession and the tariff fallout that could create some kind of global depression. According to macro analyst Adam Kubisi, it's so bad that the risk of a credit event happening in the USA has risen to 2023 regional bank crisis levels. Another economist, Alex Kruger, posted something pretty damn chilling over on X. He thinks that tariff tensions with Europe possibly retaliating, we might know more about that by the time you're watching this video, put us a couple of tweets away from a credit market breakdown. And it's very hard to stop the snowball once it starts rolling down the hill. Things can really start unwinding. This is economic chaos on a level basically never seen or not seen in an incredibly long time in markets. He went so far as to compare it to the 2008 financial crisis, which was pretty bad for markets. Now, where positive news and increased liquidity did not help, okay? So a lot of positive news came out during that time. It didn't help because everybody's so afraid. So what's driving this widening of the credit spread? First, we need to understand how U.S. Treasuries work, why their yields are dropping. So when you buy a Treasury bond, there's a face value amount to that. That's the amount that you pay to get the bond. So let's imagine that's $1,000. Then there's the fixed interest, also called the coupon, which let's say is $50 per year. That means for your $1,000 investment, you're going to earn a 5% annual yield. It's pretty straightforward concept, right? The yield is just that $50 divided by the 1,000, Now, here's where things get interesting. If more people buy treasuries, the law of supply and demand starts kicking in. So when demand goes up, the face value of a treasury, that is what you pay to buy it, also goes up. So let's say that a $1,000 bond now costs $2,000 because so many investors want to get their hands on it because they see it as a safe haven asset. The fixed interest does not change. You're still getting $50 a year, but what does change is the percentage yield. Since the price is now $2,000, that in turn means that the yield is no longer 5%. Okay, you're still getting the $50, but the percentage yield is only 2.5% now. So that's the $50 divided by $2,000, right? So the higher the demand for treasuries, the higher their price, and thus the lower their yield. Pretty straightforward idea, right? And that's exactly what's happening right now. Treasury yields are dropping, corporate bond yields are spiking due to extreme fear in the market, hence the very fast widening of the gap, creating the potential for a credit crisis. Now, before we get into the rest of this conversation, dig into some of the details here. Guys, if you're trading these markets, especially if you're trading crypto, you're trading Bitcoin, Ethereum, Solana, whatever it might be, you need a good exchange to do that on, somewhere you can long and short with very deep liquidity, huge range of pairs. You got to check out BitUnix, especially some of you guys. I know you might be somewhere where it's not so easy to get a good option, but this is available to everybody, everywhere, no KYC, no VPN. All you have to do is click on that link down below and sign up to start your account. You get $10 for free just starting your account, 20% deposit bonus, meaning deposit $1,000, you get $200 back, and up to $500 in trading bonuses. Super big deals. Go check it out using the link down below, because remember, doesn't matter what's going on in the market. You can make money long in the rips, you can make money short in the dips, but you need a good exchange to do it on. Link down below. So, why is the demand for treasuries shooting up like this? Well, since Donald Trump's inauguration, the S&P 500 has lost $10 trillion in value. Ouch. Just last Thursday and Friday alone, more than $6 trillion were wiped out in the biggest two-day market crash basically in history, and that is terrifying investors. Now check this morning, the traditional market in extreme fear territory. So in times like these, where do investors go? Where do they run? Well, would you feel comfortable lending all of your money to a corporation right now? When it seems the sky is falling, the markets are shaky, fear is high. What is the future going to hold? Can these companies survive? Probably not. I mean, in terms of lending your money to them, a lot of these companies will survive, but that's what the fear is saying right now. Sure, some big players with deep pockets and some big balls might bite on some of this stuff, but only if the yields on those corporate bonds are high enough. But for most investors who can't stomach any risk right now, U.S. Treasuries become the go-to solution. Treasuries are seen as the safest bet because the government always pays its debt, at least in theory. The yield on treasuries might not be super amazing. In fact, it's actually dropped to below 4% for the 10-year treasury right now. But it's a simpler choice. And would you rather make 4% a year or lose 20% or 30% holding your stocks? That's what most people are thinking right now. Because when you invest in bonds, you have at least some sort of certainty that your money is going to be secure, even if the returns aren't as exciting. They might be than they are in buying Tesla or Amazon or something like that. It's a lot safer. Now, this situation, of course, matters to everyone, even if you're not into stocks or any kind of investing. Why? Because none of this at all happens in a vacuum. This affects the entire economy. When less money flows into corporate bonds, guess what happens? Companies struggle to borrow the cash they need to expand and to hire more people and all that kind of stuff. Those bonds are a key way that businesses get funds to keep running and to keep growing. If they can't borrow, they can't pay their employees, okay? They can't buy new equipment. They can't build that new office or expand to that new market or whatever it might be. That leads, of course, to tightening of the belt at companies, which might mean them even cutting costs. So they're going to start laying people off. Projects that were halfway done are going to be just mothballed, right? Some of these companies will go bankrupt if things get worse. Right now, in April 2025, the U.S. unemployment rate is at 4.2%, which isn't terrible. In fact, it's just off of record lows, but it's been steadily creeping up. And the fact that it's creeping up is terrifying investors. The lack of capital for companies is only going to speed up that problem. Okay, if they can't borrow money to hire more people, they're not going to hire as many people. Unemployment's going to keep going up. And when more people are out of work, consumer spending drops, which means companies don't make as much money. They don't buy as much stuff, right? That's very problematic, because if companies aren't hiring people and people aren't buying stuff because everyone's broke, then profits for companies go down, which leads to more layoffs. And it's basically a negative feedback loop until it hits the bottom. One problem just keeps feeding into another, making everything worse. Now, here is a critical silver lining. This economic mess could be good for Bitcoin, and there's no guarantee we're going to have a credit crisis, just by the way, put that out there, but cracks are starting to appear, things are starting to look bad. Now, the US dollar right now is weakening. The US dollar index has dropped over the past 10 weeks. Bitcoin often rises when the dollar falls due to their relative inverse correlation. It's not an immediate impact, but it's sort of a general direction of the flow of money. Meanwhile, central banks like the Fed are reducing quantitative tightening. A lot of central banks around the world are already starting to print money. M2 money supply steadily rising. That means more cash for people to spend and invest in, but that money needs to start moving around and sloshing around the system. Second, market turmoil is pushing investors into safer assets like Treasury bonds, but this lowers yields below 4%. Investors craving higher returns could still see Bitcoin as a better bet than corporate bonds. For savvy players, a 4% bond yield is what Bitcoin can deliver in a week. More investors now view Bitcoin as a form of digital gold, a bit of a safe haven. And look, Bitcoin versus a lot of the stocks has held up relatively well. Knock on wood. Yeah, it's volatile, but holding Bitcoin has historically paid off pretty well, this compound annual growth rate being way beyond that of the S&P 500. Bitcoin's independent, uncontrolled by anyone, ignoring events like Liberation Day or tariff wars to some extent. There are no tariffs on Bitcoin, right? It's credible, neutral international money. Well, the S&P 500 saw a bloodbath last week. Bitcoin held up relatively well by comparison. Yeah, it's dropped off a bit today, and it's in the red at the time of recording. But when you compare it to stocks and how it usually move, in terms of beta to stocks, usually moves 2 to 3x versus stocks, it's actually moved less than the indexes, which is crazy. Now, this, of course, tells me that more and more people are at least paying attention to Bitcoin in some form in these times of uncertainty. So that's an interesting thing to note, at least. Perhaps we're finally getting what Satoshi envisioned, and people are starting to use Bitcoin as their reserve asset savings account. Don't know. We'll see. Remains to be proven as a theory. We're basically risk off everything right now. Everything's in a downtrend. And a credit crisis is probably not going to be good for anything, including Bitcoin. But long-term, Bitcoin, of course, will be a big winner from all this monetary uncertainty and the money printing and quantitative easing and lower interest rates and all the stuff that goes along with it. Easy money times will return, just not today. Thanks for watching.